All right, all right. Good evening, traders. Happy Tuesday. Only 5 shopping days left till Christmas. Spent some time in a mall today. Pretty close. Pretty close to being done. Few more things. Hello, Sandy. Good to see you. Oh, I've got someone not coming in. Let me get them in from the waiting room here. All right, I think that's everybody. We might just jump right in. Another good day in the market. How'd everyone do? How's everyone doing? Got some trades on? Got some things working, I hope. Our posture is bullish, has been increasingly bullish. I think we've really caught some good things. Feel good about what we've been doing. Let me know if you feel like you were close, but maybe you didn't, did you hesitate? Did you wait too long, get in too early? Let's talk about it tomorrow. Tomorrow morning at our weekly check-in. Tonight, welcome out to the Market Watch Group Options Foundations. Today, I can't believe for our December month of options, 8 sessions in our Options Foundations course. We're looking at revamping, possibly trying to condense the Trading Foundations course a little and expand the Options Foundation course a little. I'm flexible, adapt or die, words to live by. Be water, my friends. But we're 4 of 8 down. We've talked about the basics. We've talked about terminology and key concepts and buying options. We've talked about selling options. We started talking about credit spreads. Now what? Now we're talking about debit spreads. Debit spreads. So good evening, everybody. And welcome out to the Market Watch Group. Options Foundations, Debit Spreads. My name is Scott. I will be your host. Hi, Perry. Good to see you. Hello, everybody. Hope your week is going well. Having a blast with both my kids home from college and actually getting to hang out with them a little bit. That's been fun. Okay, let's get into it. Disclaimers, here they are. And they're also in your email if you ever want to look at them there. And here is today's agenda. I'm going to make a New Year's resolution to be a little bit more succinct and efficient in my presentations, to give a little bit more time for Q&A at the end. I'm not making any promises, but I'm telling you, it's on my resolution list. Also, to put 10 pounds of muscle on. I don't know the order of priority yet, but those are 2 of my big ones. Today's agenda, what are we doing? What is a debit spread? So let's definitionally define it. Let's talk about what is the construct that creates a debit spread, because we've got a lot of different spreads. Credit spreads, debit spreads, time spreads, calendar spreads, diagonal spreads, butterfly spreads, condor spreads, iron condors, all kinds, synthetic stocks. Oh, we can do just about anything. So let's make sure that we get our building blocks in place to understand. Now, I brought this up on Thursday last week when we did our debit spreads, and I'm going to address it again now. People will say, well, what's better, credit or debit? There's no better, there's just different. You'll hear a lot of people tell you that they like credit spreads better than debit spreads because they like putting money in their account. I put money in my account on day 1. Did you? Show me that money. Oh, you can't because it's not in your account. I mean, technically it went in there, but that money's being held in a margin account. You can't spend that money. You can't trade that money. The government can't tax you on that. The government's not going to be like, hey, you put money in your account on day 1, buddy. It's not profit. It's credit. Yeah, that's the distinction. Credit is not profit. Credit is I sold to open, which means what? I need to buy to close or let it expire worthless. But don't just think, oh, I put it in my account, so that's fantastic. Okay, that's day one. What about day two? Is it working? Because if it's not working, it's going to turn into a loss. Yeah? Okay. Please ask questions as we go. I will try to give time for us to regroup at the end and answer some questions. But if I talk about something, you're like, wait, what? Put the question out there. I'll make sure I get to it. What is a debit spread? We're talking about that. What are the types of debit spreads? We have a bull call and a bear put. How do you remember that? You memorize it. There's no quick trick or anything. You just simply say a bull call spread and a bear put spread. Those are my debit spreads. We'll talk about each one, how we construct them. Obviously, we're focused more on bull call spreads than bear put spreads, but we do want to have the ability to trade bear put spreads. We want to discuss the factors influencing spreads. We want to talk about risk management. Risk management, exit strategies. We're also going to throw risk profile in the mix on that slide. I forgot to adjust my title on my agenda slide, but we will talk about the risk profile. We're going to discuss some practical considerations and tips, and then we'll summarize it. Let's get started. What is a debit spread? The definition of a debit spread is buying. That's the driver of the trade, hence the debit. You're paying for it. The buyer of the trade is that I'm buying an option, but then I'm also selling an option simultaneously using the same stock, same expiration date, like credit spreads. Same stock, same expiration date. When we get into time spreads next week and we talk calendars, which we are in a magical time for calendar spreads, I'm very excited about that. Already started putting them on. And we'll talk about diagonal spreads. These are spreads that work well in a low implied volatility market, which is what we're in. VIX below 12 for the first time since the pandemic. Yes, it's low implied volatility. Why is that important? Well, because when the implied volatility is at historic or near historic lows, where do you think it's going to go from here? Stay low or go up? But it's very unlikely to go much further down. If the implied volatility is high and we start thinking, oh, I think it's going to, right? Maybe after a correction or a consolidation, market drops 10%, volatility's up in the high 20s. Well, if the market's up, if the volatility's up in the high 20s, what's going to happen to it as the market starts getting bullish again? That vol is going to drop from 28 to 12, just like we saw from October to now in December. If you buy calls during that, can you still make money? Yes. It's going to be harder. If you're in a situation when the implied volatility drops pretty fast, it's harder to make money buying calls. If you've ever had a time where you bought a call, the stock went up and you're like, gosh, my call's not making any money. It must be broken. Options don't break. What happened? Whatever you gained from the stock moving the right way, you lost from implied volatility going down and time ticking. Right? We always have more moving parts that we have to consider when we're looking at options. So, like credit spreads, same stock, same expiration date, just buying and selling different strike prices. We are entering this as a net debit, as the cost of initiating the position. So what's my margin requirement? Well, that was a trick question. There is no margin requirement. Anytime I pay a debit, other than stock can potentially have a margin requirement. If I buy stock on margin, I'm going to pay half of what the value of the trade would be, and I'm borrowing the other half. Then I do have a margin requirement to maintain. When it comes to options and entering a new options trade, if it's a debit, if I buy a call, if I buy a put, if I buy a calendar spread, if I buy a debit spread, if I buy a butterfly spread, anything that I buy, there is no margin requirement. And the risk is limited to what I paid. You cannot lose more than you put into a trade When it's a debit, when it's a credit, you can open yourself up to enormous losses, way more than the credit itself. But when it comes to debits, when it comes to what you paid for, this is max loss. What I paid is max loss. There are two types of debit spreads. Two types of debit spreads. We have bullish debit spreads and bearish debit spreads, just like we have bullish and bearish credit spreads. But this time it is reversed. This time, when we are doing bullish debit spreads, we're using calls, and we are creating a bull call spread. If I am bearish, I am using debit spreads and puts. This would be a bear put spread. And you'll notice it's the exact opposite. Hello, Bob. Glad you could make it. Didn't miss too much, just a couple of intro slides. So if I am doing credit spreads, it's the exact opposite. Calls are the bearish side, and it's a bear call spread credit. Bull put spread or bull call spread, debit. If I am doing a bearish debit spread using puts, it's a bear put spread. What is the put equivalent for credits? It is a bull put spread. So that's what I mean when I say you just kind of have to remember, because there's two variations of both. There's two call spreads for bullishness and, or excuse me, there's two types of call spreads, two types of put spreads. One is bullish, one is bearish. You just have to remember which is a credit and which is a debit. There's no quick, easy way. I promise you, you just have to say it out loud over and over, quiz yourself and say, yeah, got it. Bull put, bear call, credits. Bull call, bear put, debits. Which is better? There is no better. They're just different. They are what they are based on how we build them, meaning what strikes we choose, how far apart the strikes are, how much time we put into it. Okay, so let's dive into the next piece. The types of debit spreads. I think I mislabeled my slide. What am I doing here? No? Yeah, I did. I have a repeat. Sorry, skip right through that. Types of bull. We just did types. Sorry. Bull call spreads. Let's start with that. What do we need? Well, break it down. What's the first word? Bull. Start with a bullish outlook. Positive market sentiment. Does that mean we have to have a positive market posture? No, you don't. If you're a -5 because the market just took a big fat dump, and then you go to a -3.5, and then you go to a -2. And then let's say you go one more week. I would be okay after those first two. I'd be like, oh, there seems to be momentum coming back in here. I think I'm going to do some directional trades bullishly now. Would I buy calls? No. Why? Because the volatility is probably still high. If the volatility is probably still high, I don't want to buy calls. I want to mitigate that high volatility by doing a spread, which means I'm either going to do a bull put spread or a bull call spread. Doesn't really matter which. If somebody's like, oh, it matters, Scott, let me show you this beautiful bull put spread. I'd be like, great, now let me show you its bull call spread equivalent. And everything about that trade would be exactly the same. Delta, theta, vega. You would not be able to distinguish how they behaved. Okay. I start with a positive market sentiment, and I have an expectation of rising asset prices, meaning what? Meaning one of my stocks on my watch list that I think is going up is in a buyable position. Now, the last thing I would put in here, whenever I make my slides and then I deliver it, I always will. In fact, I'm excited for the second round of each of these so I can clean up a few of these presentations. But the last thing I would add is implied volatility should be medium to high. If implied volatility is low, it's no benefit. using spreads. Unless maybe your time factor is 12 days or longer. But if you're just doing a 5 to 7 day swing trade and low implied volatility, a spread is not going to be that beneficial to you. There's not enough time for time to actually impact the trade. 5 to 7 days, 12 days, maybe it starts to help out, right? Especially if implied volatility is low and each day doesn't cost very much. What are the components of a bull call spread? Number one, you start. Now, I say you start as if you do one leg and then you do the other. You don't. You start by selecting a lower strike call option, meaning what call are you going to buy, the long call. That initiates your bullish position. Remember that as a buyer, a holder of a bullish call, you have the right to buy that stock at that specific price, your strike price. Then we consider, but remember when we place the trade, it's all at once. This is an advantageous trade in the market maker's eyes. Remember that a market maker's job is balance. For every buyer, they want a seller and vice versa. Well, in this case, even though it's not the exact same contract, you're coming in as both. So if you normally could get your spread down to 5 cents per contract, I wouldn't be thinking 10 cents for the spread. I'd be thinking 6, maybe 7 for the spread. I should be able to get favorable execution. Again, let's make sure that we are still trading high liquidity, but that's an objective of ours at all times for our watch list. But yeah, that's definitely something we want to consider. So what am I doing? I'm selling a higher strike call option to generate premium. What is that premium going to do? Well, as soon as I sell something, I obligate myself. It obligates me to sell the underlying asset at a higher strike price. But I have the right. So at the same time, I have the right to buy and the obligation to sell. Let's just, in our minds, create an example. Let's say I have a stock at $51 a share. If I were to buy a call, I might buy a $50 call option. Then what? Well, I don't think it's going to go, to the moon. I might decide to sell a $55 call option. Buy a 50, sell a 55. Now, I might pay $3 for the call and then collect $1.25 for the call that I sell. So what does that mean? It means instead of paying $3, I only pay $1.75. And kudos to Bob for his comment. He said, reduce cost. I'm selling time value of an out of the money option, and I'm taking that premium to reduce the cost of what I'm paying for. So instead of paying $3, I'm only paying $1.75. However, I can't make money past 55. So if you think it's going to 65, you don't want to do that. And does that mean you should go sell a 65 call? No, because if you're only going to get 15 cents, it doesn't really make sense, right? Just buy the call. But if you think, hey, this thing might get up to 55, 56, maybe 57. Okay. Well, I'd rather pay $1.75 with the potential to make $3.25. It's fixed. Is that even 2 to 1? It's not. It's close. It's close. It's just under 2 to 1. But remember, probability is on my side. I don't need this thing to make a move to 60. It's at 51 right now. It only has to move $4 and I'm at max gain. So why are we doing this? We're doing this for increased probability of success. We're doing this because it controls our risk. We definitely put a cap on our potential for reward, but it allows us to more effectively control and manage our risk. This is the basic construct. I buy a call and sell one higher. The higher one pays down the cost of the first. I have a very fixed, now is the fixed cost of the two combined is max loss. But even then, I'm not willing to lose it all. These trades move very slowly compared to buying a call option. If I buy an option with a delta of 0.6 and I sell one with a 0.25, my net delta is 0.35. It's going to move much slower than if I just bought the call. Both ways, both up and down. Both up and down. Okay, that is a bull call spread, and that's what we're going to look at tonight. Obviously, right? We're going to look at a bull call spread tonight as an example. Let's go to the other side, because eventually the market will go bearish. We almost saw that happen, but not quite. Eventually we will see a bear market. And when we do, we want to be ready. Ready for what? Well, here's what we want to be ready for. Trading a higher volatility scenario, right? I'll tell you one thing. When I do bearish spreads, my time frames are significantly less. Stocks walk upstairs and fall out windows. Remember that. Walk upstairs, slow and steady, trending up, and then, oh shit, fall out windows. A little bit more violent. It's fast. It's far. So, can we do well with that with spreads? Absolutely. What do we need? We need to start with a bearish outlook on the market. You need to be like a -1, -2 or lower. We haven't seen that. We got as low as -0.5 for 1 week before the market made its dramatic recovery. So this is just not something we have had to take into consideration since last year. Now, last year we had a bear market most of the year. So there we would have loved. Anyone trading last year during the bear market in 2022? And if so, how did you do? How were your bear strategies? Do you feel like you did well, or do you feel like, man, I really wish I knew more? I started trading right at the tail end of a bull market. This was 1999. The year was 1999, and a young Scot just starting to trade. I did all right in the last tail end of the bull market, because you know the rules about a bull market. You guys know what they say about the bull markets. Then it switched into a bear market. And I, first of all, didn't switch. Not nearly as quickly as I should have. And then I didn't really know how to trade a bear market. But I certainly wish I could have. And in looking backwards at that bear market, knowing what I know now, oh, I would have crushed that market. Absolutely would have crushed it. But here we are. So, yes, start with a negative market sentiment. Start with an expectation of declining asset prices. Start with high implied volatility, all of which you're going to see. All of which you're going to see when you have a bearish market. Okay. Okay. Next, what are the components? Exactly the same, just the opposite. Those are the components. Exactly the same, but now instead of buying a lower strike call, we're buying a higher strike put. That's our, oops. So bad. That's on me. Give me 1 second. This adjustment I can make very quickly here before anybody even saw it. Maybe you saw it and you're like, I saw it, Scott. I saw it. If you didn't see it, don't go back. Just pretend like there was nothing there. There's nothing to see here. There's nothing to see here. Okay, live and learn. Absolutely right. Okay, let's get back into it. Whoops. Let me swap that out. Okay. So we buy the higher strike. That's our long put. That initiates our bearish position. You have the right to sell the underlying asset to somebody else, to put it to them at a specific price. Then we go and we sell the higher strike put. What is, or excuse me, oh my gosh, I am, my slides. What is happening here? This is terrible. My apologies that I thought I had those taken care of, but they did not get changed as I thought they did. So a lower strike put. Okay, my goodness, Scott. Get it together. Get it together. Display settings. Okay, back in business. Whoops is right. Do they both make money? Absolutely not. Absolutely not. We make money on one, we lose money on the other, right? Unfortunately, but that's part of the game. That's part of what we're getting into. Okay. Mitigating the cost. That's exactly right. Well said. Well said. So we buy the higher strike put, we sell the lower strike put. We're pointing this thing down, right? The one that costs more is the higher strike. The one that's lower is out of the money. We're just selling that thing to help make our long put cheaper. That's it. Make the long put cheaper. So those are the basic components. We have negative market sentiment. We expect it to decline. We buy the higher strike put. We're not going to do this one now. We're only going to do a bull call spread. Buy the higher strike, sell the lower. That's our spread. Okay. What are the factors that influence your spreads? Primarily, it's the same three: price, time, and volatility. Time decay, theta. Time decay or theta influences spreads by eroding the value of options over time, impacting the profitability of strategies as traders aim to capitalize on the differential decay rates between options and spreads. We have a positive theta and a negative theta. What do we want it to be? We want the positive theta to be bigger than the negative theta, ideally. If not, that would make us theta positive. If we're not, then we want to become theta neutral. If not theta positive, theta neutral. So you're either capitalizing from time decay or you're mitigating time decay. This is where it's an improvement to just buying an option. If I buy a call or I buy a put, I am always theta negative, and it tends to be at a pretty big rate. So we realize, hey, if I can just stop time, that would be fantastic. So if it goes up, I'll make money and I don't have to worry about it going up while time's going down and I'm not getting anywhere. How do we do that? Spreads. Spreads. That's how. Volatility or vega affects spreads by influencing the premium of options, leading traders to choose spread strategies that benefit from changes in implied volatility. But same thing, only in reverse. I would rather be vega negative, because when are we putting these on? If implied volatility is low, options are cheap. What are we doing? We're buying them. If implied volatility is not cheap, medium, or high, now what? Now we want to mitigate or benefit from time. We want to mitigate or benefit from volatility. In order for us to do that, it's expecting volatility to drop. We need to be vega negative. Vega negative. You're going to see how your option pricing model is going to be very helpful in achieving these characteristics of the spread. Lastly, price movement or delta impacts spreads by determining the sensitivity of options to changes in the underlying assets guide. If I am doing a bull call spread, I will be delta positive. The delta I buy is bigger than the delta I sell. So we slow down delta in order to mitigate or benefit from time and volatility. That's the sacrifice. That's the trade-off. We want to make sure that we are selecting spread strategies that align with both our expectations of directional market movements, like bullish spreads for upward moves, bear spreads for downward moves, but also the overall volatility scenario that we're seeing in the market at that time. Okay, let's keep going. Risk profile, management, and exit strategies. Can we set stop loss orders? Absolutely, can and should. I can set a stop on the spread, or I can set a stop on the underlying stock to close the spread if something happens within the underlying stock. That's a fundamental risk management technique that allows us to define predetermined exit points, limit losses, protect capital in case the market goes the wrong way. Can we close the position before expiration? Can and should. Closing the position before expiration enables you to either realize profits or cut losses, avoiding uncertainties associated with the final days of contracts. I've seen it happen. Right? My rule of thumb, when I get to 80%, I'm going to start taking some profits. In this case, I would say definitely it's going to maybe be in that quarter to third, but I'm going to be more likely to take at least half off. You've made 80%. There's not much left to make. Imagine how you would feel if you buy a spread for $2 and it's a $5 wide spread, right? You have a chance to make $3 and it's up $2.40. You bought it for $2, it's at $4.40. What's the highest it can get to? $5, right? You've got 60 cents left on the table. And then all of a sudden you're pushing to the end. And all of a sudden, that last couple of days, boom, 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 boom. When it falls right through your break even, right? Because you're thinking, well, if maybe I can hang on and get at least a little profit. Oh, shit, now that's gone. Maybe it'll come back. Oh, down, right? And all of a sudden, you're at 40 cents, 50 cents, and you're like licking your wounds. You paid $2, you're selling it for 50 cents, you're down $1.50. Was it 4.40? 4.40. You could have just booked it. What are we doing? Pigs get fat, hogs get slaughtered. Don't be greedy. 80%. Same with credit spreads. Any vertical spread, credit or debit. If I get 80%, I'm going to be taking most, if not all. And as I get closer, if I get 10% more, if I get to 90, you're risking, if you ended up at break even, you did a 9-to-1 against. I'm not going to do it. Highly exponential near the end. Close before it expires. 80% of profit potential. You're going to know exactly what your profit potential is on the spread. If I have a $2 debit with a $5 spread, the difference is my profit potential. I can make 3. What's 80% of 3? 240. You'll be able to see it on your risk profile as well. So when I've made 80% of the potential max gain, and we can always calculate max gain, that's it. I'm getting out. And it's the same thing. And it's the same thing with losses. I can take my losses early, right? I can take my losses early. One thing for you to understand, there's a concept called gamma risk. I don't have that anywhere in my slides. And you might think, what is gamma risk? Gamma is delta's delta. So gamma tells us how fast will delta change one way or the other. The more time we have, the more gamma we have, right? There's more cushion. Or excuse me, the more time we have, the less gamma, the more cushion. Things don't move so fast. As that time erodes, gamma expands. What does that mean? It means that if our gamma is huge, on the very last day, if the stock drops, we're going to give back profits at an enormously fast rate, way faster than you had seen at any point earlier in that trade, period. That's going to happen. How do we avoid that? A willingness to close before expiration. We want to be very predetermined with those. Adjust the trade based on market conditions, right? If your market conditions change, if the stock conditions change, be ready to change. Always be watching the risk profile. Always, always, always. We're going to come back to this. I'm going to just jump in. Let's build a trade. Okay, lot of trading signals today. A lot of things. I mean, look at this. Apple gave a signal. Not here, anticipatory, but I was willing. We got signals from Aflac. Anticipatory were yesterday. Confirmation today. I would imagine a lot of you got these trades yesterday. Not Apple, but Aflac or AIG. I'm going to find one that has a little bit. Now, why am I not stopping here? Because my volatilities are not very high on any of these, right? I'm going to see who has higher volatility potentially. APH, setting up. AXP. Oh, AXP, you've been so magnificent for me. I love you. Boeing, still going. BK, starting to pull back. Maybe BLK as well. BX. Nah, I got nothing today. I was out yesterday. Right? You see that yesterday and you're like, I'm done here. Citigroup, that's potentially a trade. Vol's a little higher there, maybe. COF. I'm going to just pop through these pretty quickly. Let's just see who has the best vol. Google. Oh, we talked about that Monday morning. I hope everyone took that one early enough to get in while the getting's good. Gap looks pretty good. Okay, here's one. Let's go with Gap. Got a great signal. Great signal today. Nice turn. Implied volatility is low at the bottom, but it's actually still 43%. So if you look at that versus, say, Apple, which is at 17, AIG 17, BX 29, and then all of a sudden, right, we look at Gap. Gap's at 43. No, there, look at Home Depot. Oh, IBM is getting close. You guys feeling that one? Intel possibly kicked back into gear. I'm loving this market. Nope, we're doing Gap because we don't have too much time. Let's go in. Stocks. So where would the in the money option? I mean, I could go to 20. Right? Now, where do I think it's going to go? We went from 18 to 22, about 4 points, 21 to 25. So let's do a 20 by 25. A lot of times people just do one point wide. They're like, oh, 21, 22. That's just lazy. That's just lazy spread trading. They're just taking whatever the model gives them, right? Let me show you what I mean. We come in here to GPS and we go in here. We'll go out to the Januaries and we're going to go to a vertical spread. Remember what I said. If you're doing debits, you're a buyer. Which column is buyers? Ask. The bid is for sellers. The ask is for buyers. Are we doing a bear put? Nope, we're doing a bull call. So I'm going to come over here. Now, this one is saying that it's 20 by 20.5. I don't care about that. I'm going to start there, and then I'm going to change this. Now, I might go to all the way to 25. I might only go to 24. Okay, so let's start there. If I just bought a $20 call, it's going to cost me $2. I think I'm going to even go a little bit closer still. Let's go 20 by, I'm going to go 20 by 22. I'm going to go a little closer, pay it down a lot. So instead of paying $2, I'm paying $1.16. I want that to be emphasized. Instead of paying $2, I'm paying $1.16. So I've reduced my cost, not quite 50%, but pretty close, right? Now I go to the risk profile. Now my target is 25. Now, what would my stop loss be on something like this? I'm wrong. If it breaks below this level here, I'm going to put my stop just below this low, 20.58. I'm going to go 20.5. 20.5. Okay, so you can see a little bit of time decay. How do I know that? Because this green line is below this purple line. I'm losing $3 a day down there. That's not terrible. Right? Remember what I said our objective was to either capitalize theta positive, mostly anything above this little crisscross, we are theta positive. Yeah. From our stop loss into this area here, we have just this little negative patch of theta. It's only $3 a day, but we are losing money down there. Isn't it nice to be able to know? I know that. I know these things. I don't have to guess at it. Okay. Now, what is my risk? $400. Too much. We only want to risk $250. Risk control says drop it back to either 6 or 7 contracts. I'm going to go 6 contracts. Okay. 6 contracts. Let me actually dial this in. Oh, yeah, 6. 6 is good. Around 250 bucks. What's my gain? 425. 2-1. Right? I'm getting 2-1. What if it takes a long time? Well, what's great is, as I advance this, you can see my theta is actually getting bigger. Look at these numbers in theta. Now it's at 6, 7, 8, 9, 10, 11, 12, right? The longer it goes, the more money we make. What does this have to do? What does this have to do for us to make money? It has to not go down. If we stay in it until expiration, it has to not go down more than 45 cents. So it could drop 2% over the next month, and we would still actually break even on the trade. We don't want to break even. We want to make money. But what I want to show you is probability is in our favor. All we needed to do is stay above 2160. What are the odds it stays above 2160? 50-50. 50-50 odds. Is that good enough? Well, if I have 50-50 odds with almost 2-1 potential, that's a very positive expectancy. That's all I'm looking for. That is all I'm looking for. I don't use this a lot, but I'm going to show you real fast. Here's our probability over time. What's the probability that we stay above, right? That we're staying above that 50-50, 50-50. Okay. Let me know if you have any questions about that. That is a risk profile. Nope. Let me show you the risk profile one more time. I got to emphasize one more thing in there. One more thing to emphasize. And that is max risk, max gain, right? This is capped. This doesn't keep going higher. It's capped sideways. Same with this. The most I could lose, is down here. The most I could gain is up here. I'm not willing to think about the most I could lose. This is the way I would look at this trade. Let me show you this. This is going to be a fun, colorful exercise. Let's start with what I'm not willing to have happen. Okay? I am not willing to let this trade go down here. Just not going to happen. What I want to happen is I want this trade to stay basically anywhere above. Well, no, I'm not going to put that there. I'm going to put it here. Anything above 22, I'm in line to make max gain, or if it goes up to 25. Then I have this period in the middle, but remember that it's not that simple. I've got this here, but mostly green in this area, mostly red down in this area. There's not a lot of ambiguity. Once this thing gets kicked forward, probability is on my side. So why are we doing spreads? Because probability is on my side. That's why. Do I like credit spreads or do I like debit spreads? Yes. I personally like them better than credit spreads. I find that it's easier to build the trade the way I want to build my trade. I am not enamored by the fact that I'm collecting a credit because I know very well it's not my credit yet. Okay. Okay. Always good to connect it on a risk profile. Here's a few practical considerations and tips. Selecting the right underlying asset. Critical. Well, I'm not worried about us. Yeah? I'm not worried about us. We have a beautiful watch list. We work very hard to maintain a beautiful watch list. Period, right? So we want to make sure we understand liquidity, check. Volatility, check. Correlation with market trends, check. And that'll enhance the effectiveness of our strategy. Proper position sizing. Obviously, we always talk about risk. We talk about what is the risk per contract. We always size the risk to control it. We define it. We manage it. We control it. And we justify it. All four dimensions every time we trade, no exceptions. We want to ensure the size of the debit spread aligns with risk tolerance and overall strategy, avoiding any overexposure or over trading to changing conditions. Whoops. Monitoring the trade and staying involved. Obviously, we vigilantly monitor trades. We constantly check in with our market news, events, and potential disruptors. We want to make adjustments as necessary. We want to maximize profits. We want to mitigate losses. That's what we do. Lastly, make sure you have carefully considered market conditions before initiating a trade. Again, if these are the practical considerations and tips, how do I feel about how well prepared we are with what we do in our group? Extremely. This is what we do. We carefully evaluate prevailing market conditions all the time. We constantly consider factors like implied volatility, economic news. This is how we trade. This is what we do. Okay, let's jump in. Summary. Debit spreads, buy and sell options simultaneously. We have bull calls and bear puts. What are you going to do? I would recommend trading both for a few times, but pick one or the other. Which one seems to resonate more with you? Pick that one. Trade that one. Practice that one. Get good with that one. Then you can figure out, hey, you know what? Every now and again, I don't like what I'm building, and I might try a credit spread because there just may be a certain setup or dynamic about that trade. But that's what I would say, right? I do not fear the man who practices 1,000 kicks one time. I fear the man who practices one kick 1,000 times. Pick it and be good at it. Don't be a jack of all trades, master of none. What are the components? Both long and short options, therefore limiting our risk, but also limiting our gain. What are the risk factors? I hope you understand already how much we're getting into theta, vega, and delta. You're Greeks. But we're talking about time decay, which is theta. We're talking about volatility, which is vega. And we're talking about directional price movement, which is delta. Risk management. We always look to incorporate stop losses, but never want to get stopped out on an opening price. We always talk about position sizing. And with spreads, we want to consider exiting at 80% of max gain and showing a willingness to close your positions. Boom, a little bit over. Been answering questions along the way. But what are your questions? They don't have to be about today's material. But if you have any, let's ask them. What's next on Thursday? Our final pre-Christmas options extravaganza. Calendars or time spreads, calendars, diagonals. But what are your questions on debits? Have any of you traded any vertical spreads? Vertical is both credit and debit. Let me know. Let's say we are in the green with the example. Do we let it expire or close it out? Depends. Stephen, great question. So let's say we make it 2 weeks. Today's the 20th. So let's go to the 3rd. We've made it 2 weeks and the stock is at 23. Ba-da-boom. At 23, I have made $334 in profit out of a potential $504 of profit. I've made approximately 67%. Approximately 67%. Okay, it's not 80, but it's getting close. So if you were like, hey, it's a weekend, I think I'm going to take some profit, or I'm thinking, yeah, right, then I would. If I didn't have that yet, I probably wouldn't. I want to get it. I would like to get at least 50%, or else I'm going to stay in the trade. However, if the trade goes wrong, clearly we're done, right? We're not going to stay in the trade if it's going wrong. Bob says he took some profit on a calendar spread today. Calendar spread, yes. You can see that's this trade. We all put this on. Well, not we all, but put this on. This is a time spread. Theoretically, this trade does better if the market drops. But volatility has gone up a little bit, so we've made some money there. Time has ticked. We've made some money there. And that's offset what we've had. Let's go to the analyze on this one real quickly, just before we wrap this up. It doesn't seem like we have any other questions. Here's SPY. This is the trade. Let's go back to today. And where are we? We are out. So look where we are. Now, here's the thing about this. Do I need to take profit on it now? No. Could I? Yes, I definitely could. What else could I do with something like this? I could wait a little longer. If it gets out here, let's say it takes till next, let's see, what day is today? What do I have? January 5, January 19. I have plenty of time to give it another week. So let's say that it goes until not the 25th, but the 26th. On the 26th, look how much I'm making. If it were to drop back here, I'm at $500 for what? I haven't done anything. I have hardly looked at it. If it drops, let's say the market goes up here and it's at 477, you're still making $230. And then what? Then I go put on a, gosh, can I get, how far am I here? That's 7 points. Yeah, let's do a 484. Let's do analyze, buying, what have I done? Nope. Sorry. Analyze buying the 484 options. Oh, yes. Now, let me just 1 second here. This would obviously cost us more. What do we pay for the other ones? Let's say it's a buck. What was it? A buck 18? Let's say it's about the same. Buck 15. Put that on. No, it wouldn't be that much. Let's go 95. Now, as time continues to expire, what happens? It raises back up again. We have a lot of different ways that we can play this. So yeah, took some profit. Great. Actually, you did pretty good because this was a buck 18. If I'm making a buck, it was a buck 19 is what we paid. What am I looking for? I would like to get 20 to 25%. 119. Oops. 119 times 0.2. 230. So 24 cents. Times, yeah, $240. You got 20%. Well done. Well done. Love it. Love it. All right. I got to run. We got a little distracted on calendar spreads. That's a preview for Thursday. I love these. Could we put another one on? Going out to January. I think we could ride this one a little more, but yeah, I think we could do more there. Join me Thursday, calendar spreads. Join me tomorrow. Let's talk about this market and how much we love it and how much we enjoy trading in it. It's a lot of fun. A lot more. I'm having a lot more fun in November and December than I did in September and October. I don't know about you guys. It's a lot easier. Maybe I got smarter. I don't know. Something happened. Something. Have a wonderful day. Have a wonderful night. And as always, happy trading.